Have you ever bought a stock because someone on Telegram said it would double your money, and then it fell 30, even 50%? You're not alone. It's not bad luck, it's a missing skill. Today I'll hand you the exact toolkit professional investors use before buying a single share. Picture buying a used car. Would you buy it just because it looks shiny in a photo? No, you'd check the engine and mileage first. Buying a stock deserves that same check. We'll cover 7 ratios in 3 buckets: valuation, income, and efficiency. By the end, you'll screen any company's numbers yourself in under 10 minutes. The price to earnings ratio. How many rupees are you paying today for every rupee this company earns? A high PE often means investors expect strong future growth. A low PE can mean trouble ahead. Let's compare company. The market prices their future growth differently. Never compare PE across sectors. A bank and a steel company naturally sit at different ranges. Price to book compares the market price to what the company would be worth if sold today. Bank X trades at a lower price to book than Bank Y. The market prices their quality differently. PB works best for banks and factories. It's almost useless for software or consulting companies. PEG fixes PE's biggest flaw. It factors in how fast the company is actually growing. A low PE isn't always a bargain. Sometimes it just means the business has stopped growing. PEG below 1 is generally undervalued. Above 2, the price may be running ahead of growth. Dividend yield is your yearly cash income, sometimes shown as a percentage of what you paid. X company has long been a favorite for investors chasing steady, reliable dividend income. Watch out, a sudden yield spike often means the price crashed, not that payouts increased. Return on equity shows how well management turns shareholders' money into actual profit. Lend a friend 1 lakh rupees, get back 20,000 in profit, that's a 20% return. X company has held strong ROE for years, a sign of consistent, efficient management. Careful, heavy debt can artificially inflate ROE. Always check debt levels alongside this number. ROA asks a bigger question. How efficiently does the company use everything it owns? Some companies sit on huge assets but generate thin profits from them. That's low ROA. Don't compare ROA across industries. Banks naturally show lower ROA than asset-light IT firms. For banks, net NPA is often the very first number. Professionals check before anything else. It shows what percentage of loans given out are not being repaid on schedule. Below 1% is excellent. Above 3% is risky. Above 5% is a major red flag. Bank-wise consistently low net NPA is a big reason it trades at a premium valuation. Would you buy a phone based only on the camera spec? Of course not. Every ratio has a blind spot. That's exactly why the other ratios exist to cover it. Before investing, run through 7 questions. Is the PE reasonable versus close competitors? Second, is the price to book attractive relative to the quality of the business? Third, is the company growing fast enough to justify its valuation? Check the PEG. Fourth, does it pay a consistent, sustainable dividend, not just a high one? Fifth, is ROE above 15% and has it stayed there for several years? Sixth, is ROA stable or improving year over year? Seventh, for banks, is net NPA below 2% and trending down? PE and PB tell you if it's cheap. PEG checks if that price is justified by growth. Dividend yield is your cash income. ROE and ROA show how efficiently the company operates. Net NPA checks a bank's loan health. Together, these 7 numbers replace guessing with a process. If this made fundamental analysis, hit like, subscribe, and turn on notifications. Next video, we go deeper, reading a company's balance sheet, P&L, and cash flow statement. Until then, keep learning, stay disciplined, and invest wisely. See you in the next one.